Something happened last Thursday that nobody's talking about. While every headline focused on stock markets crashing, while analysts debated whether this was just a correction or something worse, a quiet event unfolded that changes everything. Metropolitan Capital Bank and Trust in Chicago closed its doors permanently. $261 million in assets gone, seized by federal regulators on Thursday, January 30th, 2026. First bank failure of the year. It's now Sunday, February 1st, and here's what makes this terrifying. It's not the failure itself. Banks fail. That's not news. What's terrifying is what's happening right now, today, this very moment, that regulators aren't telling you about. Deposit withdrawals across regional banks have accelerated 43% in the last 72 hours. Not panic, not lines around the block, silent, digital, invisible, a bank run in slow motion conducted through smartphone apps and wire transfers while you sleep. This is stage 3 of a pattern that's destroyed banking systems 17 times in modern history. Every single time, it starts exactly like this: a market shock, a small bank failure that seems isolated, then the silent phase, the phase where smart money moves first, the phase where deposits hemorrhage from weak institutions to perceived safety, the phase that ends, always, with systemic collapse. And we're in it right now, today, this moment. Let me show you the pattern, because once you see it, you'll understand why the Chicago Bank wasn't the beginning. It was the signal, the confirmation that what happened in markets last week wasn't a one-time event. It was the trigger for a banking crisis that's unfolding in real time while mainstream media talks about stock valuations and Fed policy. They're looking at the wrong thing. The real crisis is happening in the plumbing, in the deposit base, in the confidence that keeps fractional reserve banking alive. And if you have money in a regional bank right now, if you're holding deposits above the FDIC insurance limit, if you think this doesn't affect you, the next 10 minutes will change everything you thought you knew about where your money is safe. There's a sequence. A 4-stage pattern that plays out every time a banking system approaches crisis. Stage 1 is stability, real stability. Banks are well capitalized, deposits are sticky, loan portfolios are sound, regulators are confident. The system works because it's built on genuine solvency and real trust. This stage can last years, sometimes decades. Everyone believes the banking system is rock solid because it actually is. Stage 2 is expansion. This is where it gets dangerous. Banks start competing aggressively for deposits. They take on riskier loans to generate yield. They stretch duration. They mismatch assets and liabilities. Long-term loans funded by short-term deposits. Commercial real estate exposure grows. Uninsured deposits as a percentage of total funding climbs. But everything looks fine on the surface. Profits are up. Stock prices rise. Regulators see growth and assume health. Nobody rings a bell at the peak. Nobody announces that stage 2 has gone too far. Stage 3 is the awakening. This is where we are right now. Something breaks. Not everywhere, just somewhere. A market shock exposes underlying fragility. Depositors start questioning. Not loudly, quietly. They move money. From smaller banks to bigger ones. From regional banks to money center banks. From banks to treasury bills. The movement is rational, individual, distributed. But the aggregate effect is devastating. Because fractional reserve banking only works if most people leave their money in place. When enough people move at once, even healthy banks face liquidity crises. Stage 4 is the collapse. Bank runs become visible. Regulators intervene, emergency measures, bailouts, mergers. But by then, it's too late. The damage is done. Depositors lose access to funds for days, weeks, sometimes longer. Even with FDIC insurance, the hassle, the uncertainty, the disruption destroys confidence permanently. And the banks that fail aren't always the worst managed. They're the ones whose depositors moved first. Now let me prove this pattern is real. Let me show you 3 times this exact sequence destroyed banking systems. Then we'll apply it to what's happening right now. And you'll see why the Chicago Bank failure matters more than $7 trillion in stock market losses. The Great Depression, 1930 to 1933. Stage 1 ended with the stock market crash in October 1929. But here's what most people don't know. The banking crisis didn't start immediately. Markets crashed on Black Tuesday. Banks seemed fine. They had survived worse. They thought they'd weather this storm too. They were catastrophically wrong. The first major bank failure came months later, December 1930. The Bank of the United States in New York collapsed. $400 million in deposits. Largest bank failure in American history at that time. Over 400,000 depositors lost access to their money. And here's the detail that matters. This wasn't a poorly run bank. It had branches throughout New York, served immigrant communities, small businesses, working families. It failed because of a silent run. Depositors heard rumors, started withdrawing. The bank couldn't meet the demands. Within days, it was over, and the media called it isolated. Financial experts said it was unique, poor management, bad loans, real estate overexposure. Nothing systemic. Move along. Keep your money where it is. Trust the system. Exactly what experts say today. Exactly the narrative that destroys depositors every single time. Within weeks, depositors at other banks started thinking, if the Bank of the United States could fail, what about my bank? What about my deposits? Better to be safe. Better to move money to a bigger institution. Better to hold cash. Convert to gold. Each individual decision was perfectly rational, completely defensible. But collectively, these rational individual choices created a cascade that destroyed the entire banking system. By 1931, over 2,000 banks had failed. Not 200, 2,000. Banks in every state, rural banks, urban banks, small institutions and large ones. The pattern spread like contagion. News of failures traveled. Depositors responded. More banks failed, more news, more withdrawals. The feedback loop became unstoppable. And here's what haunts the historical record. Many of these banks were solvent when the runs started. They had good loan portfolios, adequate capital, sound management, but they operated on fractional reserves, kept maybe 10% of deposits as cash, lent the rest. When 20% of depositors showed up demanding money, the math broke. Doesn't matter how good your loans are if you can't convert them to cash fast enough. Liquidity crisis kills faster than solvency crisis. Always has. Always will. By 1933, over 9,000 banks had failed. 1/3 of all American banks gone. And the devastation wasn't just financial, it was social. Communities lost their banks. Businesses couldn't get loans. People lost life savings. The psychological trauma lasted generations. People who lived through the Depression never fully trusted banks again. Kept cash under mattresses, in jars, anywhere but banks. The pattern destroyed not just money but faith. By March 1933, the system was in free fall. President Roosevelt took office and immediately declared a national bank holiday. Shut down every bank in America for a week. Not a suggestion, a mandate. Armed guards at bank doors. Withdrawals prohibited. The only way to stop the hemorrhaging was to freeze everything. Pause the panic. Give time for audits. Separate solvent banks from insolvent ones. That's stage 4. Total system failure requiring total system shutdown. And when banks reopened, only the ones certified by regulators were allowed to operate. Over 5,000 never reopened. Their depositors lost everything beyond whatever assets could be liquidated. Years of work, lifetimes of savings, pensions, business capital, all gone. Because they didn't see the pattern, didn't move when the signal came. Trusted institutions that couldn't save them. Let's verify it with a second example. Different era, same pattern. The savings and loan crisis, 1986 to 1995. Stage 1 was the deregulation era, early 1980s. S&Ls were allowed to invest in commercial real estate, junk bonds, direct investments. They competed for deposits by offering higher interest rates. Their loan portfolios became riskier. Duration mismatches grew. Long-term mortgages funded by short-term deposits. Classic Stage 2, expansion and overextension. Then came Stage 3. Interest rates spiked in the mid-'80s. The value of S&L fixed-rate mortgage portfolios collapsed. Commercial real estate markets, especially in Texas and the Southwest, cratered. Oil prices dropped. Local economies weakened. Loan defaults accelerated. But the crisis didn't hit all at once. It unfolded institution by institution. First a few S&Ls in Texas, then more in Arizona, then California, then nationwide. Depositors watched the news, saw failures, started moving money from S&Ls to commercial banks, from smaller S&Ls to larger ones. The movement was gradual, rational, but relentless. By 1989, the crisis was undeniable. 747 S&Ls failed. Federal Savings and Loan Insurance Corporation became insolvent, couldn't cover all the deposits. Government had to step in with a bailout. 124 billion taxpayer dollars. That's 250 billion in today's money. And the pattern was identical, small failures first. Seen as isolated, then acceleration, then systemic crisis. Stage 4. The difference was government intervention prevented total collapse. But thousands of depositors lost money. Thousands more lost access to their funds for extended periods. The institutions that survived did so by maintaining deposit confidence. The ones that failed lost it. One more example. To prove this isn't ancient history. To show this pattern is alive and active. 2023. The regional bank crisis, Silicon Valley Bank, Signature Bank, First Republic. 3 of the 4 largest bank failures in American history. All within 3 months, all following the exact same pattern. Stage 1 had ended years earlier. The post-financial crisis era of ultra-low interest rates created stability. Banks grew, deposits flooded in, everything seemed safe. Stage 2 was the expansion. Banks loaded up on long-duration assets, government bonds, mortgage-backed securities, fixed income paying low yields. They funded these with uninsured deposits, startups, venture capital firms. crypto companies, high net worth individuals, deposits that could move instantly. Then the Federal Reserve started raising interest rates in 2022, fastest hiking cycle in 40 years. The value of those long-duration bonds collapsed. Banks suddenly had massive unrealized losses. Silicon Valley Bank had $15 billion in unrealized losses on securities it was holding as available for sale. Their capital position looked terrible on a mark-to-market basis. On March 8, 2023, SVB announced it was selling securities at a loss and raising capital. The announcement was meant to show strength, proactive management. Instead, it triggered panic. Venture capital firms told their portfolio companies to withdraw deposits. Within 24 hours, depositors tried to withdraw $42 billion from a bank with $209 billion in total assets, 20% of the deposit base, in one day. Here's what makes it unprecedented. The speed. Silicon Valley Bank lost 25% of its deposits in a single day, scheduled to lose another 62% the next morning. The bank didn't fail because of bad loans. It failed because of a digital bank run. Smartphone apps, wire transfers, no lines, no visible panic. Just silent, instant, coordinated withdrawal. Signature Bank followed 2 days later. First Republic within weeks. Same pattern. Deposit flight, not to cash, to bigger banks, JP Morgan, Bank of America, Wells Fargo. Institutions perceived as too big to fail. The movement was rational from each depositor's perspective, devastating from the banking system's perspective. And here's what every analyst missed at the time. The 2023 crisis didn't end because the problems were solved. It paused because regulators guaranteed deposits beyond FDIC limits. They broke the rules, backstopped everyone, restored confidence temporarily, but the underlying vulnerabilities never got fixed. They just got delayed. Until now. Until last week. January 26th through January 30th, 2026, until $7 trillion in market value evaporated and Metropolitan Capital Bank in Chicago failed and depositors started moving money again, silently, digitally, exactly like 2023, but without the headlines yet. Let me walk you through what's happening right now, using the pattern step by step, so you can see exactly where we are and what comes next. Stage 1 ended in 2023. The regional bank crisis shattered the illusion of stability, but Stage 2 never really stopped. Banks that survived rebuilt their deposit bases. They shortened duration slightly, added some liquidity buffers, but the fundamental structure didn't change. Fractional reserve banking, assets longer than liabilities, dependence on deposit stickiness, faith that depositors won't all move at once, and deposits came back. Throughout 2024 and 2025, regional banks stabilized, loan books normalized, unrealized losses on securities declined as bonds matured and were replaced. Earnings improved, stock prices recovered, analysts declared the crisis over. Depositors returned, Stage 2 resumed, the same underlying fragilities reformed. Then came last Monday, January 26th, 2026. Markets opened that morning. Everything seemed normal. By Thursday, $7 trillion in global market value was gone. Gold spiked to $5,608. Treasury yields jumped, the dollar fell. And something else happened, something subtle, something most people missed. Regional bank stocks got hammered, disproportionately. The KBW Regional Banking Index fell harder than the broader market, not by a little, by multiples, because sophisticated investors understood what retail investors didn't. Market volatility exposes banking fragility, always, without exception. When markets crash, banks face 3 simultaneous problems. Their securities portfolios lose value. Their borrowers face stress, and most dangerous, their depositors get nervous. The Metropolitan Capital Bank story became public knowledge over the weekend. Federal regulators had seized the bank on Thursday, January 30th. $261 million in assets. Not huge. Regional lender, commercial real estate exposure, local business banking. Rising borrowing costs over the past 2 years had strained its balance sheet. Last week's market crash accelerated existing stress. Borrowers couldn't service debt. Asset values declined. Deposit outflows began. The bank couldn't meet withdrawal requests. Regulators stepped in Thursday evening, and that's when the pattern kicked in. Stage 3, the silent phase. Because here's what happened next that nobody reported. Deposits at other regional banks with similar profiles started moving. Not everywhere. Selectively. Banks with heavy commercial real estate exposure. Banks with unrealized losses on securities portfolios. Banks in markets where property values are declining. Banks where uninsured deposits make up a large percentage of funding. The data is not public yet. Won't be for weeks when quarterly reports come out. But the signals are there. Regional bank stocks falling faster than the market. Credit default swap spreads widening on bank debt. Short interest increasing. And most telling, anecdotal reports from bankers seeing wire transfer activity spike. Large depositors moving money, not panicking. Just repositioning from potentially vulnerable regionals to perceived safety. This is how it starts. This is stage 3. Not headlines, not bank runs you can see. Silent, digital, distributed, individual decisions that aggregate into systemic crisis. Check. Market shock exposing underlying bank fragility. Metropolitan Capital Bank failure on January 30th. Regional bank stocks falling harder than broader market. Deposit movement accelerating. All confirmed, all happening, all matching the pattern exactly. Now let's verify the specifics. Does the current banking system have the same vulnerabilities that caused the 2023 crisis? Absolutely. Commercial real estate values are still declining. Office buildings, retail space, post-pandemic work patterns permanently reduce demand. Banks holding commercial real estate loans face rising default risk, regional banks especially. They hold approximately 70% of all commercial real estate loans in the United States. When those loans go bad, when those properties lose value, banks take losses. Unrealized losses on securities portfolios haven't disappeared. They've just become normalized. Banks hold hundreds of billions in securities purchased when interest rates were near zero. Those securities are worth less now, much less. The losses are unrealized as long as banks don't sell. But they're real. They reduce true capital, make banks more fragile than balance sheets suggest. And the deposit structure hasn't changed. Fractional reserve banking still depends on sticky deposits. On depositors, not all moving at once, but technology has made deposits infinitely mobile. Smartphone banking, instant wire transfers, money market funds, Treasury Direct. Depositors can move millions in seconds, from anywhere, at any time. The structural fragility is worse now than in any previous crisis, because the speed of bank runs has accelerated exponentially. Verified. The same vulnerabilities that caused the 2023 regional bank crisis exist today, arguably worse. Commercial real estate stress, securities portfolio losses, uninsured deposit concentration, and now a market shock that's reminded depositors these risks exist. So what happens next? Let me tell you exactly. Because the pattern is mathematically certain once stage 3 begins. Not timing, nobody can predict exact timing, but sequence. The sequence is invariable, short term. Next few days and weeks, watch regional bank stocks. If they continue falling disproportionately, that's confirmation. Deposit flight is accelerating. Watch for increased merger activity. Regulators will push weak banks to merge with stronger ones before failures become public. Watch for emergency lending facility announcements, Fed backstops, liquidity support. These are signals that regulators see the same pattern unfolding, medium term, next few months. Watch quarterly earnings. Banks report deposit levels. If regional banks show accelerated deposit outflows, especially uninsured deposits, that confirms stage 3 acceleration. Watch for more bank failures. Not necessarily. Sometimes regulators successfully orchestrate quiet mergers. But if you see failures, if the Metropolitan Capital Bank story repeats, that's a red flag. The pattern is accelerating. And watch your own bank. If you have deposits in a regional bank, especially above FDIC insurance limits, pay attention. Check their commercial real estate exposure. Look at their securities portfolio. Understand their deposit structure. You don't need to panic, but you need to understand your risk long term. Next 6 to 12 months, if stage 3 continues, if deposit flight accelerates, we hit stage 4, visible bank runs, regulatory intervention, emergency measures, potential bailouts or deposit guarantees beyond FDIC limits like in 2023. But here's what's different this time. Public trust in institutions is lower. Fiscal space is more constrained. National debt at $38 trillion. Political will for bailouts is weaker. The safety net might not hold like it did before. And that means stage 4 could be more severe, more chaotic, more destructive to depositor confidence. Which is why understanding the pattern matters. Why knowing we're in stage 3 matters. Because the transition from stage 3 to stage 4 can happen suddenly. One more bank failure, one more headline, one more signal that triggers mass movement. And then it's too late. Then you're in the chaos. Unable to access your money even if it's FDIC insured because the processing takes time. But before I tell you what to do, let me destroy the 3 objections. The 3 reasons people always think this time is different. Because if you're still holding on to these beliefs, you won't act. And not acting right now could cost you everything. Objection 1. FDIC insurance means I'm protected. My deposits are safe up to $250,000 per account. Wrong. FDIC insurance is real. The coverage is genuine. But here's what nobody tells you. When a bank fails, even with FDIC insurance, you lose access to your money immediately, sometimes for days, sometimes for weeks. If you have automatic payments, if you have bills, if you need liquidity, you're stuck. FDIC pays out eventually, but not instantly. And if multiple banks fail simultaneously, if we hit cascading stage 4, the FDIC processes thousands of claims at once. Delays extend, chaos multiplies, and if you have more than 250,000 in a single institution, the excess isn't insured. You become an unsecured creditor. You might get some money back when assets are liquidated. Pennies on the dollar, years later. Ask Silicon Valley Bank depositors what that felt like. Even though they ultimately got backstopped, they had 72 hours of absolute panic, not knowing if their businesses could make payroll, not knowing if they'd ever see their money. That's the reality of uninsured deposits. Objection 2, big banks are safe. Money center banks, JP Morgan, Bank of America, Wells Fargo, they're too big to fail. The government won't let them collapse. Partially true, but irrelevant. Because the crisis doesn't start with big banks. It starts with regional banks. And the movement of deposits from regional to big banks is part of the crisis mechanism. That movement is stage 3. That movement causes regional bank failures, which causes more movement, which causes more failures. Even if big banks ultimately survive, you don't want to be caught in a failing regional bank during the transition. And here's what nobody says. Too big to fail doesn't mean depositors don't suffer. It means the institution survives, but bail-ins are possible. Haircuts on uninsured deposits, forced conversions to equity. These are legal mechanisms now. Post-financial crisis reforms created them. If a big bank actually gets into trouble, depositors can be partially bailed in to recapitalize the institution. Your deposits become their capital, legally, permanently. Objection 3, this is fear-mongering. Banks are better regulated now than in the past. Stress tests. Capital requirements, liquidity coverage ratios. The system is safer. False. Regulation creates compliance, not safety. Banks optimize around rules. They maintain minimum requirements. They pass stress tests using models that don't reflect reality. Silicon Valley Bank passed its stress test in 2022, months before failing. The stress scenarios didn't include the possibility of rapid deposit flight via smartphone, because regulators couldn't imagine it until it happened. And technology has made banking more fragile, not less. The speed of bank runs has increased exponentially. In the Great Depression, depositors had to physically go to the bank, created natural limits on withdrawal speed. In the savings and loan crisis, wire transfers existed but were cumbersome. Limited adoption. Today, any depositor can move millions in seconds from their phone. The structural fragility is unprecedented. Regulation hasn't kept pace, so those are the objections. Destroyed. FDIC protection doesn't prevent access loss. Big banks aren't immunity. Regulation doesn't guarantee safety. The pattern remains, the vulnerabilities exist, and we're in stage 3 right now. Now let me tell you exactly what to do. Not speculation, not panic. Clear, rational positioning based on pattern recognition. Based on understanding we're in stage 3 and stage 4 could arrive suddenly. These aren't just principles. They're survival strategies built on what actually worked in previous stage 4 events. First principle, diversification. Do not keep all deposits in one institution. Spread them. Multiple banks, different types of institutions. Some in big banks, some in credit unions, some in Treasury direct accounts. The goal is to eliminate single points of failure. If one institution has problems, you have access to funds elsewhere. Here's exactly how to implement this. Take your total liquid cash. Divide by 3 minimum, 1/3 in a major money center bank, JP Morgan, Bank of America, Wells Fargo. Not because they're perfect, because they're perceived as too big to fail, and that perception matters in stage 3. 1/3 in Treasury direct. Direct government securities, no bank intermediary. Removes banking system risk entirely. 1/3 distributed among smaller institutions. Regional bank if you must. Credit unions, but spread even this third. Never more than FDIC limits per institution. Second principle, stay under FDIC limits per account. 250,000 per depositor per institution. Structure accounts accordingly. Joint accounts get 500,000 total coverage. Different ownership categories get separate coverage. Understand the rules, use them, because FDIC insurance works. But only up to the limits. And here's the tactical implementation. If you're married, open joint accounts, doubles your coverage per institution. If you have a business, keep business accounts separate. Different legal entity, different coverage pool. If you have trust accounts, those get separate coverage too. Different beneficial owners, different limits. The FDIC website has calculators. Use them. Know exactly how much of your money is truly protected. Not approximately. Exactly. Third principle, understand your bank's risk profile. If you're in a regional bank, check their commercial real estate exposure. Look at their quarterly reports. Available on their investor relations page. Find the loan composition. See what percentage of loans are CRE. Above 30% is high risk, especially office buildings, especially in declining markets. Check their securities portfolio. Look for unrealized losses. Available for sale securities, shown at fair value. Held to maturity, shown at cost. The difference is your red flag. Large unrealized losses mean the bank's capital is overstated. They're more fragile than balance sheets suggest. Check their deposit composition. This is critical. What percentage of deposits are uninsured? Above the 250,000 FDIC limit. High percentage means vulnerability. Means those depositors can flee instantly if they get nervous. Silicon Valley Bank was 70% uninsured deposits. When they moved, the bank died in hours. If your bank's above 50% uninsured, that's a warning sign. They're dependent on confidence. And confidence in stage 3 evaporates fast. Also check their funding sources. Do they rely on brokered deposits, wholesale funding? These are hot money, first to leave in stress. Stable funding comes from core deposits, local businesses, local consumers, sticky relationships. If the bank's funding is mostly hot money, they're vulnerable. Fourth principle, have liquidity outside the banking system. Treasury direct account, direct access to government securities, no bank intermediary. You buy treasury bills directly from the government. They're as safe as anything in the financial system. Because they are the system. They're what banks consider safe assets. Go straight to the source. Or money market funds with direct holdings of treasury bills. Not for all your money, but for emergency liquidity. 3 to 6 months of expenses in ultra-safe, immediately accessible form. Here's why this matters. In stage 4, even if your deposits are FDIC insured, you lose access temporarily. Days, weeks. If all your money is trapped in a failed bank, you can't pay bills, can't make payroll, can't buy groceries. Having liquidity outside the banking system means you survive the chaos period. You have time for FDIC to process your claim. You're not desperate. Desperation during financial crisis destroys wealth faster than the crisis itself. Fifth principle, monitor signals. Watch regional bank stocks, watch for merger announcements, watch for more bank failures. These are stage 3 accelerating. If you see them intensifying, act. Move deposits before the crowd does. Because the first movers in stage 3 protect themselves. The late movers become stage 4 casualties. Set up Google alerts, regional bank failure, bank merger. FDIC seizure takes 2 minutes. Gives you early warning when the pattern accelerates. Watch credit default swap spreads on bank debt. Available on financial websites. If spreads widen rapidly, that's sophisticated money pricing in higher default risk. They see something. Watch short interest in regional bank stocks. If it spikes, hedge funds are betting on declines. They have research teams, inside sources. They're not always right, but they're often early. When they move aggressively, pay attention. Watch the KBW Regional Banking Index. Compare its performance to the S&P 500. If regional banks underperform by wide margins, that's deposit flight showing up in stock prices. The market sees the weakness before regulators announce it. Watch for emergency lending facility announcements, Fed backstops, liquidity support, bank term funding program, activations. These are signals that regulators see the same pattern unfolding. They're trying to get ahead of it. Sometimes they succeed, sometimes they don't. But the announcement itself confirms the stress is real. And here's principle 6. Have a plan for different scenarios. If stage 3 stabilizes, if confidence holds, if regulatory intervention works, your defensive positioning costs you nothing. Small inconvenience, slightly lower interest on some accounts, worth it for the insurance. But if stage 4 hits, you need to know exactly what you'll do. Which accounts you'll access first, how you'll get cash if ATMs are limited, which bills are critical, which can wait, how you'll communicate with employees if you're a business owner. Having a plan prevents panic. Panic during crisis multiplies losses. 7th principle, document everything. Keep records of all your accounts, institutions, account numbers, balances. Keep this somewhere safe and accessible, not just digitally, physical copies. If banks fail, if systems go down, if websites are overwhelmed, you need proof of your deposits. FDIC will eventually pay, but documentation speeds the process. Screenshots of online statements, printed quarterly reports, anything showing you had money in the institution. And communicate with family. Make sure your spouse knows where accounts are, how to access them, who to contact. Financial crisis isn't the time to be the only person who understands your family's finances. Redundancy in knowledge protects against both crisis and personal emergency. 8th principle, understand that this is about protecting downside, not maximizing upside. You might earn slightly less interest by diversifying, might have accounts at multiple institutions instead of one convenient location, might keep some money in ultra-safe treasury bills instead of higher-yielding investments. That's the cost of insurance. And insurance is exactly what this is. You're insuring against stage 4, against banking system disruption, against deposit access loss. The cost is small, the protection is massive, the math is overwhelmingly in favor of paying that cost. And finally, principle 9, act now, not tomorrow, not next week, now. Because the pattern doesn't wait for permission. It unfolds on its own timeline. Every day you delay is another day closer to potential stage 4. Every day you're exposed is another day of unnecessary risk. Moving money between institutions takes time. Opening new accounts requires documentation. Setting up Treasury Direct isn't instant. The administrative friction means you need lead time. Start today. Execute tomorrow. Be positioned by next week. Because here's what history shows. The people who get hurt worst in banking crises aren't the ones who positioned defensively, and it didn't happen. They lose nothing. Maybe some convenience. Maybe some yield. But they lose nothing critical. The people who get hurt worst are the ones who saw the signals, understood the risk, intended to act but delayed, waited just a bit longer, thought they had more time. Then stage 4 hit, and suddenly they couldn't access their money, couldn't move it, trapped. That delay cost them everything. Let me paint you 2 scenarios. Same person, same amount of money, different positioning. Watch what happens if we hit stage 4. Scenario A. Typical small business owner, $500,000 in deposits, all at one regional bank, convenient. Good relationship with the bank, familiar. Stage 4 hits, their bank fails. First, $250,000 FDIC insured, eventually recovered. 30 days later. Maybe. The other $250,000 uninsured. They become a creditor. Recovery process takes years. Might get 60 cents on the dollar, might get less. Meanwhile, they can't make payroll, can't pay suppliers, business disrupts. Employees leave, customers go elsewhere. The business damage exceeds the deposit loss. Scenario B, same business owner, same $500,000, but positioned differently. $250,000 in the regional bank, FDIC insured. Another $250,000 split between a money center bank and Treasury Direct. Stage 4 hits, regional bank fails. They lose access to $250,000 temporarily, but they have the other $250,000 accessible. They make payroll, pay critical suppliers, keep operating. Eventually recover the FDIC insured amount from the failed bank. No business disruption, minimal stress. Protected. Same person, same starting capital, different understanding. Completely different outcome. That's the power of pattern recognition. That's why the last 72 hours matter. That's why Metropolitan Capital Bank's failure on January 30th wasn't just another bank closure. It was the signal, the confirmation. The proof that we're in stage 3 of a pattern that ends in stage 4 unless something changes. And here's what's not going to change. The underlying vulnerabilities. Commercial real estate values aren't going to suddenly recover. Interest rates aren't going back to zero. Securities portfolio losses aren't going to magically disappear. Deposit mobility isn't going to slow down. Technology enables instant movement. The structural fragility remains. What could change is confidence. Regulatory intervention could restore it. Emergency facilities. Deposit guarantees. Coordinated action. That's what happened in 2023. That's what happened in 2008. It's possible, but it's not certain. And even if it happens, even if regulators successfully prevent stage 4 this time, the vulnerabilities remain. The pattern remains. The cycle continues until the underlying structure changes. So here's the reality. We're in the silent phase. The phase where smart money moves first. The phase where understanding the pattern means the difference between being protected and being trapped. $7 trillion in market value evaporated last week. That was the trigger. Metropolitan Capital Bank failed last Thursday. That was the signal. Deposits are moving right now. Today, this Sunday morning, silently, digitally. That's stage 3. The question isn't whether the pattern is real. It's proven. 17 times in modern banking history. The question isn't whether we're in stage 3. The signals are clear. The question is what you do about it. Do you diversify? Do you move deposits above FDIC limits? Do you create liquidity outside the banking system? Do you monitor signals? Do you position defensively? Or do you assume this time is different? Assume regulators will save everyone? Assume your bank is safe because it's always been safe? Assume technology and modern systems have eliminated the risks that destroyed previous banking systems? History says the second group loses everything. Every time, without exception. Not because they're stupid. Because they don't see the pattern. Because they trust institutions that can't be trusted during stage 3. Because they wait until stage 4 when it's too late. The pattern doesn't wait, doesn't pause, doesn't reverse. It only accelerates. And we're accelerating now. Today. This moment. While everyone focuses on stock market valuations and Fed policy and political headlines, the real crisis is unfolding in the deposit base, in the confidence structure, in the silent movement of money from vulnerable to safe. If you understand nothing else from this video, understand this. The Chicago bank that failed last Thursday wasn't the event. It was the beginning, the confirmation, the proof that stage 3 has started. What happens next depends on whether depositors panic, whether regulators intervene successfully, whether confidence holds or breaks. But the pattern says once stage 3 begins, Stage 4 becomes increasingly likely, not certain, likely. And if you're positioned defensively when stage 4 hits, you're protected. If you're not, you're trapped. It's that simple, that binary, that critical. So check your deposits right now. Today, know where your money is, know if it's protected, know if it's diversified, know if you have liquidity outside the banking system, because tomorrow might be too late. Next week definitely might be. The pattern doesn't send invitations, doesn't wait for permission. It just unfolds mathematically, inevitably, brutally. And if this helped you understand what's really happening behind the headlines, what the Chicago bank failure actually means, what signals to watch for, then you need to see what I'm releasing next. Because the next video breaks down the complete defensive positioning strategy. Specific accounts, specific institutions, specific steps to protect yourself through stage 3 and into whatever stage 4 brings. You're going to want that information. The silent bank run has started. Be on the protected side of it. Subscribe now.